In March 2024, BlackRock launched BUIDL, the BlackRock USD Institutional Digital Liquidity Fund, becoming the world's largest asset manager's first tokenized fund on a public blockchain. Within weeks, BUIDL surpassed Franklin Templeton's Franklin OnChain US Government Money Fund to become the largest tokenized treasury product in existence, growing to over $500 million in assets within months of launch. The broader tokenized treasury market crossed $3 billion in 2024 as institutional adoption accelerated. Tokenized treasuries represent one of the clearest institutional use cases for blockchain technology, taking the most liquid, lowest-risk institutional instrument in existence and making it available with 24/7 settlement, programmable yield distribution, and on-chain composability that opens new treasury management strategies not available with traditional treasury positions. For institutional treasury officers, CFOs managing corporate cash, and DeFi protocols seeking yield-bearing collateral alternatives, tokenized treasuries represent a structural opportunity to earn risk-free rates with the operational advantages of on-chain settlement. This analysis provides the framework for evaluating and allocating to tokenized treasury products across the institutional yield stack. BlackRock BUIDL and Franklin OnChain US Government Money Fund represent two distinct institutional approaches to treasury tokenization with different target markets and structural characteristics. BUIDL is explicitly institutional-focused, with a $5 million minimum investment and securitized managed onboarding that includes full KYC and AML verification. Franklin OnChain took a more accessible approach with a $20 minimum, positioning the product across both retail and institutional segments. Both products invest in US Treasuries and government money market instruments, providing genuine exposure to risk-free yields rather than synthetic alternatives. The blockchain layer adds settlement efficiency and programmability without changing the underlying credit quality of the investment. Both products are SEC-registered investment products, providing the regulatory framework that institutional investors require. The Ethereum versus Stellar and Polygon chain choice reflects different technical philosophies. BlackRock chose Ethereum for BUIDL because institutional DeFi protocols and on-chain liquidity are concentrated on Ethereum. Franklin's Stellar choice prioritized lower transaction costs and faster settlement at the expense of DeFi composability. For institutions prioritizing on-chain integration with existing DeFi protocols, Ethereum-based products offer more flexible use cases. The tokenized treasury operational mechanics combine familiar investment fund structures with blockchain-native settlement advantages. The fund structure is identical to a traditional money market fund. Investor capital is pooled and invested in treasuries, and yield is distributed proportionally. The innovation is in the delivery mechanism. Fund ownership is represented by tokens rather than traditional account entries, enabling 24/7 settlement and on-chain composability. The rebasing yield mechanism used by BUIDL is particularly elegant for institutional treasury management. By maintaining a constant $1 token price while increasing token quantity to reflect accrued yield, BUIDL tokens behave like traditional money market fund shares for accounting purposes. This structural choice was likely made specifically to simplify accounting treatment. No mark-to-market price changes, predictable yield accrual, and behavior similar to familiar money market instruments. The 24/7 redemption capability is a genuine operational advantage over traditional treasury funds, which settle on T+1 or T+2 business day timelines. For institutional treasury officers managing intraday liquidity needs, the ability to access invested treasury yield positions at any time without waiting for business day settlement provides meaningful operational flexibility. The tokenized treasury market growth in 2024 demonstrated that institutional demand for on-chain risk-free yield is real and accelerating. BlackRock's market leadership reflects the institutional trust premium associated with the world's largest asset manager, while Franklin Templeton's earlier entry and broader access strategy created a different but complementary market position. Ondo Finance has pioneered the use of tokenized treasuries as DeFi-native yield instruments. OUSG provides institutional access to short-duration US Treasuries through a tokenized wrapper, while USDY offers yield-bearing stablecoin functionality with treasury backing. Ondo's products are specifically designed for DeFi composability, enabling their use as yield-bearing collateral in lending protocols and as alternatives to non-yielding stablecoins in liquidity pools. The emergence of multiple competing products across different chains and with different target markets is a positive structural development for institutional adoption. Competition is improving yield terms, reducing minimum investment thresholds, and driving technical innovation in product design. The tokenized treasury category has evolved from a single experimental product to a functioning competitive market in less than 3 years. The institutional use case diversity for tokenized treasuries demonstrates that the product has found genuine product-market fit across multiple segments of the digital asset ecosystem. Corporate treasury management, DeFi protocol backing, and operational yield enhancement represent distinct value propositions with different buyer types and decision-making processes. The DeFi protocol use case is particularly significant for the long-term integration of traditional finance and decentralized finance. MakerDAO, the protocol that issues the DAI stablecoin, has allocated over $1 billion in real-world assets including US Treasuries as backing for DAI through its Spark protocol. This integration means that DAI stability is partially backed by traditional US Treasury yields, creating a direct linkage between the Federal Reserve monetary policy transmission mechanism and on-chain stablecoin stability. For institutional treasury officers, the most immediate actionable use case is replacing stablecoin holdings with tokenized treasury equivalents. Institutions holding USDC or USDT for operational purposes to pay DeFi transaction costs, settle crypto trades, or maintain on-chain liquidity receive zero yield on these holdings. Replacing stablecoin holdings with BUIDL or OUSG tokens that maintain dollar parity while distributing treasury yield converts previously zero-yielding operational capital into an income-generating position. The risk considerations for tokenized treasuries are substantially lower than most crypto asset investments, but they are not zero and require explicit institutional evaluation. The smart contract risk is real but manageable. BlackRock engaged multiple security auditors for the BUIDL contracts, and the securitized platform has multiple years of operational history with tokenized securities. The risk is more analogous to infrastructure operational risk than to DeFi protocol exploit risk. The whitelist transfer restrictions are the most significant functional limitation for institutions seeking maximum composability. The requirement that all BUIDL token transfers occur between pre-approved institutional addresses prevents use of BUIDL tokens in permissionless DeFi protocols, reducing the on-chain composability advantage. This restriction exists for regulatory compliance reasons and represents an explicit trade-off between DeFi utility and regulatory certainty. For institutions where regulatory certainty is more important than DeFi composability, this trade-off clearly favors BUIDL. For DeFi native institutions seeking yield-bearing collateral that can be deployed across permissionless protocols, products like Ondo Finance that have different whitelist structures may be more appropriate depending on specific use cases and regulatory constraints. Tokenized treasuries represent one of the clearest demonstrations that blockchain technology can add genuine institutional value to traditional financial instruments. The use case is not hypothetical or future state. BlackRock BUIDL is operational today. Franklin OnChain has been operating since 2021, and institutions are actively using these products for treasury management, DeFi protocol backing, and yield enhancement. The institutional adoption trajectory for tokenized treasuries is likely to accelerate as the regulatory framework clarifies, as product minimums decrease to expand accessible markets, and as DeFi protocol integration deepens to enable more sophisticated use cases. BlackRock's entry into this market is a credibility signal that the major traditional financial institutions view tokenized real-world assets as a durable category rather than a temporary crypto trend. For institutional treasury officers evaluating the tokenized treasury opportunity in 2024, the most practical starting point is a pilot allocation using stablecoin operational balances. Converting a portion of USDC holdings to BUIDL tokens provides immediate yield improvement with minimal operational disruption and creates institutional familiarity with the product mechanics before scaling to larger strategic allocations.